G'day. Welcome to Lunch Money, your online and social media home for special situations, workouts, and capital raising professionals. My name's Nick Samios. I'm the fund manager and director here at Hermes Capital, and I am your live stream host. We have had a very interesting week in the world of capital markets, supply chain finance, non-bank finance, etc. It's hard to pick up a newspaper without Greensill being mentioned, and I think that what's interesting about that story, it's not necessarily Greensill itself, it's just about how that situation's come about and what the downstream consequences might be. I personally think that the situation has come about largely as a result of all the free money and the money printing and post-GFC money printing. I think that whilst a lot of people aren't putting it in those terms, I think there's good reasons why we can analyse it that way. Meanwhile, this week our government has announced that they're going to give 0% loans to small businesses. And I think that that is going to create some issues in itself. I guess because of all the free money printing, a lot of people have got savings that they've set aside. We've talked about on this show before, there's $250 billion sitting in bank accounts at the moment. And now that all those savings are going to have to compete with the government as it offers home loans at 0%. Before we get into that, before I introduce our first guests, I just want to ask you to share, like, or subscribe. But if you're watching us on YouTube, set the notification bell and subscribe. And ditto if you're watching us on Facebook. If you're listening to the podcast, do us a favour and maybe even give us a 5-star rating on Apple Podcasts. That'd be very, very cool indeed. Well, without further ado, I would like to introduce our first guest. And our first guest is Barry Lau. G'day, Barry. How are you?
G'day, Nick. How are you? Nice to be on.
Very good. Now, Barry, you're a corporate and structured finance advisory chap. You're the managing director or a managing director at Constellation Capital. You're a senior corporate banking executive. You've got a lot of experience, not just here in Australia, but also in London. I think you said Hong Kong, Kuala Lumpur, and Singapore, of all places. And you're on the structured debt advisory side of things. What is it that's been keeping you busy this week?
Thanks, Nick, for having me on. Constellation Capital, we're corporate advisors, debt advisors, and focusing on helping small and mid-size companies access alternative source of capital from non-bank sources, and we work with credit funds, offshore, sort of like investment houses, security companies, and the likes. Good question. What's been keeping me busy this week? I think, as you saw, like in your intro, the news about Greensill has been on the front pages, and I've been getting a lot of calls from a lot of colleagues and friends about what is going on there. On the business side, I mean, Constellation has quite a diverse range of projects. I come from a structured finance background, and we sort of like focus on alternative debt. So we're looking at different things from acquisition financing of a global drilling rig business to a financing of a e-forklift business. I'm also sort of working with my Hong Kong partners on a property transaction. That's not an area of expertise for me, but working with some experts in the property sector for a Melbourne development. And I've got an aviation sort of background, so I'll keep my finger in the pie on some aviation transactions. So looking at, I've got an advisory role for the acquisition of some aircraft. So a bit of a wide variety of stuff, but really the key is sort of like just bringing capital to businesses where it's difficult for those businesses to obtain.
Well, that's very interesting. As a matter of fact, next week we're going to do a bit of a spotlight on aviation. So tune in for that. What sort of ticket sizes are you normally involved with?
Look, I mean, the current the current business, we're sort of like looking at $10 to $50 million sort of like ticket sizes, really sort of like helping those businesses that sort of like small to mid cap where they've got an established business, where they're unloved by the banks really, or they're looking at sort of like growing, and particularly sort of with COVID, sort of like trying to move off JobKeeper and sort of like growing their business. Possibly with acquisitions, and looking for that sort of like growth capital. So helping them sort of like structure, working with sort of other corporate advisors on the integration of businesses, but from my point of view, looking at sort of like financing of those businesses that are sort of like growing and building their business. So typically sort of 10 to 50 mil.
Yeah, it's an interesting space. I mean, you said unloved. I mean, the thing is, when it's there, so they're too big to be small businesses, and obviously banks have teams that focus on small business, and small business is a little bit political as well. But then you've got the corporate stuff where it's in the corporate finance departments. But there is a bit of a gap. I appreciate that $50 million is finding its way onto the corporate desks, but I suppose there is that sort of gap where it's way too big to be small business, but it's a little bit too small to be right up in the institution part of the bank as well. Is that where you're playing?
Yeah, correct, Nick. I mean, and also, these business owners will typically sort of like, where they've grown their own business, they may have a CFO, but they're not sort of large corporate CFOs who are talking to banks all the time, who are sort of like perhaps even in the city and sort of like having coffees with people like yourselves and knowing exactly where the cash is and where the market is. So, those CFOs are very good at their operations. They are very good accountants, but not necessarily sort of, having a full picture of where the financing opportunity or financing, sources are. So looking at that market and helping those guys.
Yeah, I guess, as noisy and as busy as I am, I mean, some people find it hard enough to find me, but you've got capital sources offshore as well?
Well, I mean, I've spent half my career in Hong Kong, Singapore, and KL, as you sort of like introed. So I've got a network of investors. I mean, it is horses for courses. A lot of institutional investors find it hard, sort of, particularly during the COVID, sort of like, and looking for bigger sort of like ticket transactions, and that's sort of covered by some of the bigger boys. But then there's a lot of sort of like smaller investors, family offices that will have an appetite for smaller deals.
And is it special sits, or is it's growth, or it's just pre-IPO, or all of the above?
Look, growth. For me, given my experience, I'm sort of like looking at growth, growth businesses. Not so much special sits. I know that there are sort of like quite a number of funds looking at special sits, and there's a potential where banks have got growing books where there are opportunities for them. But for me, it is very much sort of like helping businesses grow their business, particularly if they've got offshore connections into Asia.
Yeah. Okay. All right. Well, look, that's a good introduction, Barry. I'm going to now just pop you back into the waiting room, and we'll introduce our second guest for today, and that is Darryl Kirk. G'day, Darryl. How are you?
Nick, I'm well. How are you?
Very well indeed. Now, Darryl, you are a partner there at Cor Cordis in Brisbane. In fact, we managed to catch up the other week, which was a lot of fun. I made the mistake of, after I saw you, I was meant to be going to Perth, and I detoured via Melbourne, and that locked me out of WA. But that's another story for another time. Now you've been a partner up there at Cor Cordis for 4.5 years, and obviously you've got a long history in insolvency before that. Tell me, what is it that keeps you busy? What are you seeing up in Brisbane at the moment?
Well, Nick, there's a variety of matters, really. It's I wish I could say they're all new matters, but I think it's well known that our industry has been relatively quiet over the last 12 months, and I think largely due to the government incentive position. And I think it's for all intents and purposes, it's worked very well. But some of the matters that sort of arose last year, which are sort of taking their time to work through, but recently a sale of a silver mine. So that's one we've been working on for the last sort of 4 or 5 months. That's gone under contract as of last week. So everybody's very, very happy with that result. In fact, the contract price was about 10 times what the liquidator had it under contract for. So that's a story for another day, but it's a tremendous result in the circumstances. One of the more topical matters that we're working on is a tier 2 electrical contractor insolvency, and that had supply chain finance, and there are a number of different aspects that contributed to that particular business's demise. But at the end of the day, the supply chain finance position with that business was affected really by the recoverability of the receivable and the influence that the receivable collectability had on the viability of that business. So that's been a particularly interesting one to work through. Another one is a pre-lending review for a debtor financier involving the effect of JobKeeper. Now, this particular company is a public company, so I better be careful about divulging too much. But at the end of the day, its EBITDA for the last 12 months is about 10% below what the JobKeeper payments were to that particular business. So, there's still the underlying concern there that the business model is actually broken. Of course, the effect of the JobKeeper has really been to provide for a recapitalisation of that balance sheet. So hopefully, that's given them the time to address the restructuring that is required. And of course, a couple of matters that you and I have been involved with, recent referrals involving some debtor finance issues. Another one again yesterday. So definitely the inquiry is picking up, and you would expect that, I guess. I mean, it's been pretty much in hiatus for the last 12 months.
Well, I'll say this, Darryl. I've been telling people in your industry the last week. When we started at the beginning of this year, we were saying to people, "When do you think it's going to get busy?" And you'd have people saying, "Oh, the end of March, the end of June, the end of the year." Scratch all of that. Our inquiry is up. And I think you guys are going to be super busy a lot before you think. I think within the next few weeks, I think it's all going to hit. I've noticed that the notices, the insolvency notices are up and all that sort of thing. Listen, you've just very quickly, because we could talk about some of the things that you said there. We'd do a whole show on. I mean, firstly, you casually mentioned about your silver mine. You got a better price than the liquidator. So obviously, you're not the liquidator in that matter.
Sale out of a receivership,
right?
We were appointed after the liquidator.
Okay.
First went under contract by the liquidator, and the secured creditor decided that they wanted to take a position on it. Okay. We've been through, an extended sale process, and
so you acted for the secured creditor?
That's correct. I'm the receiver. Yeah.
All right. Well, so it sounds like there would have been a bit of rock and roll there, but we won't drill that into it now. But you got a smirk on your face for those listeners listening at home. So we'll leave that one alone. Now, there was something else that you said there about JobKeeper. Now, it's almost getting boring talking about JobKeeper coming off, but you're saying that, without no names, no pack drill, but you're saying that you're talking, to a listed company. JobKeeper is some considerable portion of their cash flow at the moment, by, one way or the other you look at it, and they can't be the only ones.
Yeah, well, what's triggered the pre-lending review, Nick, was the fact that they no longer qualify for JobKeeper because being extremely profitable during the last sort of 12 months. So, that free working capital, if you like, that was provided by the government is now no longer available, which has triggered this position for for an incoming debtor financier. I guess the risk and the question in my mind in terms of doing the review was that clearly the business model historically has been lost. And there's no doubt there's been attempts to address that during the last 12 months. But at the end of the day, as you well know, that if you've got a loss-making business going forward, then it's going to need some funding from somewhere.
Yeah.
And to then, fund it with debt is probably a riskier position than equity, right?
So I guess it needs two things. It needs some funding from somewhere, and then it needs to stop losing money. But that's another story. Listen, well, we as I say, I mean, you've got some fascinating stuff. We could spend an hour talking to you, Darryl, but we will bring Barry back. And I have got this rudimentary sketch of supply chain finance. What I've got here is I've got suppliers, and I've got the client, and I've got the customers. Right, so you've got a business that sits in the middle of my diagram here for the listeners at home, and we've got product flows from the suppliers to the business in the middle, who we'll call the business the client. So the product moves from the suppliers to the client, and then from the client does some value add perhaps, and then supplies the customers. Now payments flow in the other direction, and there's two key payment flows. There's the flows in the business from the customers to the client. So that's one stream of money, right? As the client's customers pay for their goods, and that money goes to the client. And then there's money that the client pays its suppliers. Now, where my firm sits, for example, and where a lot of my competitors sit, is in that payment stream that from the customers to the business. So there's this flow of this pipeline of money from the business's customers to its client, and that pipeline can be monetized or financialized to provide credit. And the beauty of that from a lender's point of view is that there's lots of customers, and so any risk in that transaction is spread across all those customer payments. Now, in the supply chain finance model, it's that second stream. It's the payment to suppliers that's monetized or financialized, and all the risk therefore really resides with the client that sits in the middle, because as a lender, you're not getting paid by all the customers, you're getting paid by the client itself. Now that works fine if it's Telstra or if it's Ford, I suppose, or maybe even Cynic. But that's basically the model. Now, have I got that right, Barry?
Yeah, so exactly. I think that the diagram that you have there on the right, where you've got the customers paying, that's your classic receivables finance or invoice finance or debtor financing, and you're right. That risk is spread across all the various customers. The supply chain finance is focused on the buyer and providing early payment and providing an early payment to their suppliers. And if done properly, what it does do is it actually allows suppliers early access to the early payment of their invoices, rather than sort of like waiting 30, 60 or 90-day payment terms. So if done sort of like properly, the suppliers will receive their money early, maybe on day 5 or day 10. And then the financier who actually sort of like undertakes that payment steps into the shoes of that supplier and then waits for the regular payment terms, 30, 60 or 90 days, to be paid by that client. So right. and as you say, most of those trades have trade credit insurance. That sort of ensures that those suppliers, a lot of suppliers will take trade credit insurance. They'll ensure that those suppliers, the electrician out there, an electrical contractor that sort of like Darryl was sort of like mentioned earlier, will get paid. And if they don't get paid by the client, then insurance steps in.
Yeah, I guess the important thing is that the insurance mitigates the risk. So whereas the risk in a debtor finance scenario is normally the risk from the lender's point of view is mitigated by the spread of customers, the risk in a supply chain finance scenario is often handled through the insurance. I don't think now I've been around finance for a long time, and there's been talk of reverse factoring for years. I mean, it was certainly well before Greensill's era. But is it fair to say Greensill pretty much put it on the map?
Well, so let me just declare my myself in terms of. So I did spend 18 months at Greensill, and I left about 6 months ago. So to pursue my own business and do broader sort of like financing things. Look, I mean, Greensill. Look, as you say, reverse factoring has been around for donkey's years. What Greensill is able to do is sort of like make it a wholesale product. I mean, the banks all provide this. Well, not all the banks, but a lot of banks provide supply chain financing, and like all bank products, there's limits in terms of what you could do, and there's also flexibility issues or inflexibility in terms of sort of platforms and payments and things like that. So Greensill was able to sort of like capitalize the debt capital markets and sort of make it accessible to a lot more people by sort of like having larger chunks of money thrown into this particular product.
Yeah, well, I guess they brought in the whole Well, I mean, I don't know if they call it securitization, but the whole thing of converting into bonds, I suppose, is a securitization process one way or the other. I guess, Darryl, obviously we don't provide traditional, what the strictest sense of what supply chain finance is. I do know that when we are looking at refinancing distress scenarios, the presence of some of these supply chain or even trade finances, it depends on where you are in the food chain. It does get different names. Even some trade finances really fits into this supply chain finance model. It does make it harder for us to refinance or to go in and bail someone out. Because if their whole supply chain's funded, like if their receivables are funded and then they're virtually their payables are funded as well, it makes it hard. I mean, how does it go in the restructuring space? Have you encountered it in restructuring terms?
Not overly, I have to say, Nick, but it's fair to say, Barry, that the transaction is effectively moving the unsecured creditors into a secured creditor pool, isn't it? The effect of the funding of the invoices means that the supplier invoices really are assigned to the funder. That's the correct interpretation, is it?
Yeah.
So yeah, that's right. The funder actually still steps in and assumes that those receivables that the supplier has. So yeah, technically the supplier sells those his receivables to the funder. So that's your classic sort of supply chain financing transaction, and from an accounting point of view, that customer or the client there in that case, maintains its trade payables sort of like status on their balance sheet, and that's sort of like has caused some concern in terms of discussions as to where the product should be sort of going. Should it be disclosed? Is it really a debt? And all those other issues that you see circling around in terms of discussions of this matter.
I wonder, with Greensill, I mean, I'm wondering what the downstream consequences are. Companies like Telstra and those blue chip, undoubted credit companies, they're going to pay. There's no question of certain bondholders getting paid back. There's obviously the whole separate issue of Gupta, which we won't necessarily go into. But I'm just wondering what the downstream consequences are. I mean, are there now going to be a bunch of suppliers who were used to getting paid in 5 to 10 days who are now going to have to reset their cash flows? Or is Apollo, what happens, do you think, Barry? I mean, sticking within the realm of what's in the papers, because I know that, I'm treading carefully as we both need to do.
Yeah, no, understand. Look, I mean, without sort of any names or anything, I mean, I guess, for any collapse, I guess the tragedy really is sort of like the people that's involved. So you've got 1,000 employees that sort of like are sitting there waiting for what is happening. That's one. The downstream on effects on various businesses, and the papers reported about GFG Group in terms of their need to sort of like raise financing, and the potential and the political consequences of the jobs in relation to those businesses. But specifically, the suppliers, access early payment in an SCF program, and if that program is no longer there, then the suppliers won't get access to early payment. Now, those suppliers, a lot of them, are small, medium-sized companies. They, would typically need to sort of like draw on overdrafts or even, pledge their home to sort of like try and keep the business going. So not having this early access means that's a big hit on their working capital.
And do you think there'll be a lot of that? Do you think there'll be a lot of customers suddenly looking, like a lot of the suppliers suddenly looking to reset their financials?
Look, I don't have sort of stats on that, but certainly you would think there are, and I think Darryl might actually have an example which he could sort of like talk to. But there's going to be, and it really depends on the size of the businesses. If it's a mom and pop shop, then that's an issue. If it's sort of like a big sort of multi national sort of contractor, then they have to access capital from a different source.
Of course. Of course. Well, what do you think, Darryl? I mean, did you say you had an example, Darryl, with your electrician? Was that?
That's right. In fact, these guys were actually utilising the Greensill facility. But the problem with this business was really the nature of the receivable and it being involved in the building construction industry. They were having trouble, delivering on their services. So it put in doubt the collectability of that receivable. So whilst the supply chain finance part of it was working reasonably okay for a period of time, it's still reliant upon that nature of that receivable and the borrower being able to actually collect on that receivable to make its payments under its facilities. So, I guess in that respect, it still has that traditional issue of, it comes down to the ability of the borrower to be able to access funds to make sure that it's able to service its facility. It acts no differently just because it sort of bypasses that traditional sort of working capital process. In practice, it actually works quite well. Although in this case, what did happen is there was a time when the default on that facility, and that is the supply chain finance part of the process, meant that the suppliers were still working and not getting paid, and that's because of the contractual issues that this company had with its principal. I mean, that's unavoidable.
I wonder, I guess I've got a couple of questions, and I don't know, I don't think either of you guys can answer them, but I just put them out there. I mean, I guess one of the issues here was that, one of the issues with Greensill obviously was that the insurance cover was pulled, and then that had downstream effects for their capital raising on the bond markets. And, one of the things that I pondered to myself, and again, I appreciate that you guys probably can't answer this question for a number of reasons, but is whether or not the insurance markets are seeing Greensill as a special case, or whether or not they're looking at credit insurance across the board. I mean, that's, I think, an interesting thing to ponder. And again, I don't think we're necessarily able to. Certainly, the inquiries that I've made don't seem to be that it's not. It is just being treated as a special case. But the other thing is that this week the federal government announced that they're going to launch a scheme of offering zero interest loans. Now, it's going to be targeted. It's going to be at the tourism sector and some hospitality sectors, I suppose. But, I'm a guy that makes a living out of lending money to people. And, we've certainly got buckets of cash, and we're not the only ones. I mean, there's lenders all over the countryside that have got buckets of cash. And Barry, you would know that, you're dealing with all sorts of funds firstly, I wonder whether or not the government should be competing with existing pools of funds. I find it, is that really absolutely necessary? But the other thing I wonder is whether or not this low interest rate environment that we've had for a number of years has created balance sheet pressure. I mean, we have a term you'd be familiar with this term, Barry, balance sheet pressure, where you've got a bank or a lending institution that's sitting on cash, and that cash is earning nothing, and it's got all the pressure to get that cash invested in order, to get the yields. And I wonder whether or not Greensill really, at the end of the day, was a victim of balance sheet pressure, and that's maybe why they got a little bit more exposed to Gupta than they may have otherwise wanted to be. But are you seeing balance sheet pressure in other funds that you're dealing with?
Look, I won't comment on
No.
Greensill, and I'll let the viewers sort of come to their conclusions from reading the paper. But you are right in terms of the negative carry that a lot of funds have. They're awash with funds. They're sitting there. It's earning nothing, and they've got to sort of make a 6, 7, 10% return for their investors. So the good ones know when to invest. And when to return their money back to their investors, and obviously the ones who are pressured to sort of invest in anything, suffer those consequences. But the negative rates just don't help. And your point about sort of the government, competing. I mean, unless they know exactly how to sort of compete, I find it very hard for them. So it's easy for them just to dish out money like the Feds and the RBA, sort of just doing a QE. So that's just a simple but quite a blunt way of sort of distributing cash. Doesn't help investors and sort of compete. I don't know what the solution is to that, but certainly as you say, there's a lot of cash floating around.
Yeah, I like your term negative carry. So you're sort of from a bigger end of town than I am. We're just sort of humble small guys here. We don't have that flash term. But the fact is, if you're sitting on a lot of cash, I think there's no shame in returning it if you have to. It's better than chasing bad deals. I've always said that one of the advantages that we have in our fund is we're not publicly listed, for example, and so I don't have the pressure of having to report to the stock market every month on how I'm going. And if we want to walk away from a deal, we can walk away from a deal without having to worry about how that's going to reflect. I wonder, Darryl, I mean, what are your thoughts with we've seen now for 12 months the government providing support, and it's certainly been effective and it's been welcome in certain parts. On the other hand, there have been businesses that had problems before COVID, and they've just been sitting there on life support ever since. By the time you get there, I mean, you want to be able to restructure the business. I know that you're one of the guys that does their best to try and actually get a positive outcome for everybody, as opposed to taking the simple path and just putting it all on the chopping block. But it makes it a bit harder if it's been on life support. It becomes what one of our friends in Brisbane, one of our finance broker friends in Brisbane, calls the sucked orange. What do you think about this? Should the government just step back and let nature take its course, or I guess the guys up and down the coast of Queensland do need help. Where do you sit?
Well, do you think this is going to be an election year, Nick? For the cynical, I think the government was always going to introduce another round of support packages. I think it was interesting. I think I was reading the Fin Review yesterday that the take up on the first round of these government-backed loans was actually really quite low in terms of the major banks promoting them and providing them. I think the CBA was certainly out there using this process, but I think the other banks really backed off. And so I just wonder what incentive there is actually for the banks to actually look at providing these government-backed loans. I mean, they're interest-free and P&I free for a couple of years, I understand. So, I think it is really targeted. To be eligible, you've got to have had JobKeeper in the last quarter, I think. I'm sure if I'm wrong, I'll get corrected. But, that to me sort of says, well, rightio, that they do understand that that some of these players, in particular the tourism industry, they're still going to have a difficult time of it.
Okay. And Barry, I mean, Darryl said before that he was doing a pre-lend on a listed entity that's obviously had the benefits of JobKeeper. And I assume that we're talking about substantial figures. I mean, we've already seen some companies have been handing back JobKeeper, in the order of $10-20 million plus. I mean, do you ever feel yourself, given that you sort of deal in that sort of 10 to 50 space, you ever found yourself competing for deals with government handouts?
Not personally in any of the deals I'm looking at. I mean, certainly it helps in terms of the cash flows and forecasting, but not specifically. But you have a lot of organisations, say in the renewable space, like the Clean Energy Finance Corporation. They sort of like lend and provide funding alongside commercial lenders, so they're helpful in terms of sort of like that aspect. The grants and all that stuff. They just add to the cash flow, which actually helps in terms of analysis of the risk.
Yeah. Okay. Yeah, well, that's interesting. I mean, I think that there is this term crowding out, and I think that Darryl would certainly agree that people like us and Darryl have certainly been crowded out to some extent with government money. I'm not sure it always helps. I think it's well intended. I certainly think that the low interest rates, as I say, I think that it is causing a lot of that negative carry that we talked about before. And let's face it, negative carry is what caused the GFC. It was chasing yield. It was pools of printed cash at that time that was looking for somewhere to go, and so the financial engineers needed to find different ways of slicing and dicing, and look where we ended up. So look, guys, I know this is hard to believe, and I say that every time. We're actually out of time. Can you believe that we're already nearly 40 minutes into this discussion? So what I would like to do is give you both the opportunity to just give some closing thoughts before we say goodbye, and I'll start with you, Barry.
All right. Okay. Look, I mean, I guess the theme you're looking at sort of downstream effects on SCF, and I guess my views are that there is a place for supply chain finance, as there is a place for receivables and invoice financing and other forms of structured transactions. So hopefully, when this all comes out in the wash and is reviewed, that it maybe is just an isolated event, and that the baby is not thrown out with the bathwater, and the whole financing industry in that particular area sort of like goes down, because there are lots of benefits in terms of supply chain financing, but it's horses for courses. You just have to be the right party to be sort of like using it.
Okay. Yeah, I mean, certainly, governments are certainly known to overreact. I personally believe that the responsible lending laws that we have in Australia are an Australian reaction to an American problem, but we won't go down that little hobby horse. Darryl, your closing thoughts?
Oh, I just want to echo Barry's sentiments, Nick. I think there's absolutely a place for supply chain finance, and certainly it is. It's more suited to some industries than others, but I suspect that if you take that supply chain finance availability away, then there will be a fallout. And I know each of us looks into our crystal balls each day and tries to see how things are going to play out over the next 6 months. And depending on how Greensill actually goes, I mean, there may well be a contagion effect in certain industries if indeed, that source of capital dries up for certain businesses. So it's going to be a very interesting space to watch.
Well, based on what you told us earlier, Darryl, you don't seem to have too many dull moments in your day. So I will say, Barry Lau, thank you very much for joining us. And Darryl Kirk, thank you very much for joining Lunch Money today. Thank you to those of you who are watching live, and thank you to all of you who listen or watch later on. Signing off. See you next time. Cheers, and thank you very much.